Let me tell you about a trade that most people thought was absolutely insane. In 2017, I put over $900 million into a single company. Wall Street laughed at me. The media called it a disaster waiting to happen. Even some of my own investors questioned whether I had lost my mind. The stock had been in free fall for years. The company was drowning in debt. Management seemed completely lost, and I went all in. 3 years later, that position was worth over $3.6 billion, a 400% return in 36 months. That is the power of activist investing done right. And today, I am going to show you exactly how I identify these opportunities, how I structure these positions, and most importantly, how you can spot the next company that has the potential to multiply your money 5 times over in just a few years. Now, before I get into the specifics, let me take you back to a moment that changed everything about how I think about investing. It was 2003. I had just started Pershing Square, my hedge fund. I had about $50 million under management, which sounds like a lot. But in the hedge fund world, that is basically nothing. I was hungry, I was aggressive, and I was looking for opportunities that everyone else was missing. I found a company called Wendy's, the fast food chain at the time. Wendy's owned a bunch of different restaurant brands, including a company called Tim Hortons, the Canadian coffee and donut chain. The market was valuing Wendy's as if Tim Hortons was worth almost nothing. But I had done my research. I knew Tim Hortons had incredible unit economics. I knew the brand had a cult following in Canada, and I knew that if Wendy's spun off Tim Hortons as a separate company, shareholders would suddenly see billions of dollars in hidden value. So I bought a significant stake in Wendy's. Then I went to management and made my case. I showed them the numbers. I explained how a spin-off would unlock value. I was polite but persistent. Management resisted at first. They always do. But eventually they came around. Wendy's spun off Tim Hortons in 2006. The combined value of both companies was dramatically higher than Wendy's alone had been trading at. My investors made a fortune. That experience taught me something fundamental about markets that most investors never learn. Stock prices do not always reflect reality. Sometimes the market is wrong. Sometimes companies are worth far more than their current valuation suggests. And sometimes the only thing standing between a company's true value and its stock price is a catalyst. Something that forces the market to recognize what was there all along? That is activist investing. It is not about hostile takeovers or corporate raids or any of the other scary terms you hear in the media. At its core, activist investing is about buying stakes in undervalued companies and then working to unlock that hidden value. Sometimes that means pushing for management changes. Sometimes it means advocating for a spin-off or a sale. Sometimes it just means getting a board seat and bringing better governance to a company that has lost its way. Now, let me give you the framework I use to identify these opportunities, because not every undervalued company is a good activist target. You need specific criteria. You need to understand what makes a situation ripe for change. And you need to know how to calculate whether the potential upside justifies the risk. The first thing I look for is what I call a valuation disconnect. This is when a company's stock price is dramatically lower than what the underlying business is actually worth. Now, every investor says they look for undervalued stocks, but I am talking about something specific. I am looking for situations where I can point to concrete reasons why the market is wrong. Maybe the company owns real estate that is being ignored on the balance sheet. Maybe they have a division that would be worth more as a standalone company. Maybe the core business is generating cash flows that would justify a much higher multiple. Whatever it is, I need to be able to quantify the disconnect. If I cannot put a number on how much the stock is undervalued, I move on. The second criterion is what I call identifiable catalysts. This is crucial. An undervalued stock can stay undervalued forever if there is nothing that forces the market to recognize its true value. So I look for situations where there is a clear path to unlocking value. A spin-off that makes sense. A sale process that could attract buyers. Cost cuts that management has been unwilling to make. Strategic changes that could transform the business. I need to see a specific action that, if taken, would cause the stock to re-rate higher. The third thing I look for is management receptivity, or at least the potential for change. Now, I have done plenty of contested situations where management fought me tooth and nail. I have run proxy fights. I have gone to war with boards. But those situations are expensive, time-consuming, and uncertain. The best outcomes happen when management is at least somewhat open to hearing new ideas, or when the board has enough independent directors who might be sympathetic to shareholder concerns, or when there is an upcoming shareholder meeting where I can nominate directors. The fourth criterion is balance sheet flexibility. I want to invest in companies that have the financial strength to execute whatever changes need to happen. If a company is drowning in debt, their options are limited. They cannot do buybacks. They cannot make strategic acquisitions. They are in survival mode, not value creation mode. I prefer companies with moderate leverage and strong cash flow generation. And the fifth thing I look for is what I call staying power. Activist campaigns take time. I need to be confident that the company will not blow up while I am working on the thesis. I avoid turnarounds where the business is in free fall and might not survive. I avoid companies with massive near-term debt maturities. I avoid situations where the competitive dynamics are shifting so fast that my thesis could be obsolete before I can execute it. Now let me walk you through a specific example that illustrates all of these principles. And this is a situation that shows exactly how an activist approach can potentially 5 times your money in just a few years. In 2017, Chipotle Mexican Grill was in crisis. The stock had collapsed from over $750 per S-hair to around $250. The company had been hit by a series of food safety scandals, E. coli outbreaks, norovirus incidents. Customer traffic had plummeted. Same-store sales were negative. The founder and CEO, Steve Ells, seemed unable to fix the problems. The board was stale and passive. Now most investors looked at Chipotle and saw a broken brand. They saw a company that might never recover. They saw a CEO who was in over his head. But I looked at Chipotle and saw something else entirely. I saw a company with incredible unit economics. Even with all the problems, individual Chipotle restaurants were still generating over $2 million in sales per year, with margins that most restaurant chains would kill for. The food safety issues were fixable. They were operational failures, not fundamental flaws in the business model. The brand still had incredible strength with consumers. People loved Chipotle's food. They had just lost trust in the safety. That trust could be rebuilt. I saw a situation where the stock price reflected the worst-case scenario, but the underlying business had the potential to return to its former glory. The valuation disconnect was massive. If Chipotle could just get back to its pre-crisis performance, the stock could easily triple or quadruple. And if they could exceed that performance by improving operations and accelerating unit growth, the upside was even greater. The catalyst was clear. New leadership. Steve Ells was a brilliant founder who had created an incredible brand, but he was not the right person to execute a turnaround. Chipotle needed a world-class operator, someone who had run large restaurant companies, someone who understood food safety and supply chain management, someone who could restore consumer confidence. So I built a position, a large position. I engaged with the board. I made it clear that I believed change was needed. And importantly, I did not just criticize. I came with solutions. I had a list of CEO candidates who I thought could turn the company around. I had specific ideas for operational improvements. I was a constructive partner, not a hostile adversary. The board listened. In early 2018, they brought in Brian Niccol from Taco Bell as the new CEO. Brian was exactly what Chipotle needed. He had turned Taco Bell from a struggling brand into a growth machine. He understood marketing. He understood digital. He understood how to run restaurants at scale. The results were immediate and dramatic. Brian Niccol transformed Chipotle's operations. He invested in food safety systems. He accelerated the rollout of digital ordering. He launched a rewards program. He improved the throughput in stores, so customers were not waiting as long. He raised prices strategically without hurting traffic. He streamlined the menu. He made 100 small improvements that added up to a completely transformed company. Within 3 years, Chipotle's stock went from around $250 to over $1,500. My position went from $900 million to over $3.6 billion. That is a 400% return. That is turning every dollar into $5. And it happened because we identified a great business that was temporarily broken, pushed for the right changes, and let a talented new leader execute the turnaround. No, I want to be very clear about something. Not every activist situation works out this well. I have had my share of failures. Valiant Pharmaceuticals. Herbalife did not go the way I expected. JCPenney was a disaster. Activist investing involves real risk. Companies can continue to deteriorate. Management can dig in and refuse to change. The market can stay irrational longer than you can stay solvent. But here's what I have learned over 20 years of doing this. When you get the setup right, when you have that combination of valuation disconnect, clear catalysts, receptive or changeable management, balance sheet flexibility, and staying power, the odds shift dramatically in your favor. And when you get it right, the returns can be extraordinary. Let me give you another example to drive this point home. In 2020, during the depths of the pandemic, I made another big activist bet, but this time on a company called Universal Music Group, which was then still owned by Vivendi, a French conglomerate. I had been following Universal for years. The music industry had gone through a decade of disruption. Piracy had destroyed CD sales. Everyone thought the business was dying, but streaming had changed everything. Spotify, Apple Music, Amazon Music. Suddenly people were paying for music again, and Universal owned the world's best catalog. The Beatles, Taylor Swift, Drake, Billie Eilish, decades of iconic music that people would stream forever. The problem was that Universal was buried inside Vivendi, a messy conglomerate with a bunch of other random assets. The market was valuing Vivendi as if Universal was worth maybe $15 billion. But when I did my analysis, I thought Universal was worth at least $50 billion. The streaming economics were incredible. Recurring revenue, high margins, growing subscribers globally. This was one of the best businesses in the world, hidden inside a company that no one was paying attention to. My thesis was simple. Vivendi needed to spin off Universal as a standalone company. Once Universal traded on its own, the market would recognize its true value. The stock would re-rate dramatically higher. I built a position in Vivendi. I engaged with management. I advocated publicly for the spin-off. And this time, management was actually receptive. They saw the same opportunity I did. In 2021, Vivendi spun off Universal Music Group. It started trading independently on the Amsterdam Stock Exchange. The results validated the thesis. Universal was valued at over $50 billion when it started trading independently, more than triple what it had been implied at inside Vivendi. My position generated billions in profits, all from recognizing that a great business was being undervalued because it was buried inside a conglomerate. Now here is what I want you to take away from these examples. Activist investing is not magic. It is not about being smarter than everyone else. It is about being willing to do the work. It is about looking at businesses differently than the consensus view. And it is about having the conviction to act on your conclusions. Let me give you some specific things to look for when you are screening for potential activist opportunities. First, look for companies trading at significant discounts to their peers. If a company has similar margins and growth to its competitors, but trades at half the multiple, that is worth investigating. Why is the market giving it a discount? Is it deserved? Or is there an opportunity second? Look for companies with hidden assets, real estate on the balance sheet that is carried at historical cost. Minority stakes in other companies that the market is ignoring. Patents or intellectual property that is not being monetized. Tax assets that have real value. These hidden assets can provide a margin of safety and a catalyst for value creation. Third, look for companies with bloated cost structures. If a company has significantly higher costs than its peers as a percentage of revenue, that is a red flag for opportunity. Those costs can be cut. That margin expansion can drive significant value. Fourth, look for companies with stale boards. Check the proxy statement. How long have the directors been on the board? Are they independent, or are they friends of the CEO? Do they own meaningful stock? A board that has been in place for decades with no turnover is often a board that has gotten complacent. Fifth, look for founder-CEO transitions. When a founder steps away from day-to-day management, it often creates an opportunity. The new CEO may be more receptive to change. The company may be ready to professionalize. This transition period can be a good time for activism. 6. Look for conglomerate discounts. When a company owns multiple unrelated businesses, the whole is often worth less than the sum of the parts. The market struggles to value complex structures. Simplification through spin-offs or divestitures can unlock tremendous value. And 7th, look at the shareholder base. Who else owns the stock? Are there other activists involved? Are there institutional investors who might support change? Having allies makes activism much easier. If you are the only one who sees the opportunity, that is a warning sign. Now, I want to talk about the practical aspects of executing an activist campaign, because this is where most individual investors get stuck. You cannot realistically take a 2% stake in a company and start demanding board seats. You do not have the capital or the resources to run a proxy fight. So how can you benefit from activist investing? The answer is to invest alongside activists. When a credentialed activist investor discloses a position in a company, pay attention. Read their investor letters. Understand their thesis. Evaluate whether you agree with their analysis. If you do, consider building your own position. When I disclose a new position through our required SEC filings, the stock often moves higher immediately, but that initial pop is usually just the beginning. If the thesis plays out, if the changes happen, if the value gets unlocked, there is still tremendous upside from that point. Another approach is to screen for situations where activist involvement is likely. Use the criteria I described earlier. Look for the valuation disconnects, the catalyst opportunities, the governance issues. Get there before the activists do. Be early to the idea. You can also look at activist situations that have been ongoing for a while, but have not yet resolved. These can sometimes offer attractive entry points. The initial enthusiasm fades. The stock drifts lower as the process drags on. But if the fundamental thesis is still intact, that can be a great buying opportunity. Let me now synthesize everything we have discussed into a clear framework that you can apply to your own investing. The core insight of activist investing is that value creation requires catalysts. An undervalued stock is not enough. You need something that will force the market to recognize the true value. The catalyst can come from management voluntarily taking action. It can come from an activist pushing for change. It can come from a competitor making an acquisition offer. It can come from the natural evolution of the business. But without a catalyst, value can stay trapped forever. So when you evaluate any investment, ask yourself these questions. What is this company really worth? Why is the market valuing it differently? What would need to happen for the market to recognize the true value? How likely is that catalyst to occur? And what is my downside if I am wrong? The opportunities that meet my criteria, meaningful valuation discount, clear catalysts, fixable problems, strong core business, those are the situations where you can realistically achieve 3, 4, 5 times your money in a few years. They are rare, but they exist, and they are worth waiting for. Let me give you one more piece of wisdom that has served me well over my career. The best activist investments are not the companies that are completely broken. They are good businesses that have temporarily lost their way. A great company with bad management is a better bet than a bad company with good management. Because management can be changed, but it is much harder to change the fundamental economics of a business. Chipotle was always a great concept. The unit economics were always incredible. The problems were fixable because the underlying business was sound. If you are looking for situations where activist involvement could 5 times your money, look for good businesses with temporary problems, not turnarounds of structurally challenged industries. Now let me tell you how I think about position sizing and risk management in these situations. Because even the best thesis can take years to play out, and you need to survive long enough to see the returns. I typically size activist positions at 5 to 15% of my portfolio, large enough to matter, large enough that I can influence the outcome, but not so large that a single failure destroys the fund. Even my highest conviction ideas rarely exceed 20% of the portfolio. I also think carefully about the timeline. Activist campaigns typically take 2 to 4 years to fully play out. You need to be patient, you need to have capital that can be tied up for an extended period. If you are investing money you might need in 6 months, this is not the right strategy, and I always consider the downside. What happens if I am wrong? What happens if the thesis takes longer than expected? What happens if the company's situation deteriorates further? I want investments where I am being compensated for the risk, where the potential upside is a multiple of the potential downside. Here is what I want you to remember. The market is not always efficient. Companies can trade at significant discounts to their intrinsic value for extended periods. But those discounts do not last forever. Eventually, something happens that forces the market to recognize reality. Activist investors can be that something. They can provide the pressure, the ideas, and the urgency that transforms undervalued stocks into multi-baggers. The opportunity I see right now in the market is significant. After a period of momentum-driven investing, where the most expensive stocks just kept getting more expensive, there are pockets of genuine value. There are companies trading at half of what they should be worth. There are situations where activist involvement could unlock tremendous value. These opportunities do not come around every day, but when they do, they can be life-changing. My advice is to start looking screen for the situations I described. Read the filings of successful activist investors. Understand their methodologies. Learn to see value where others see problems, because that is where the extraordinary returns come from. Not from following the crowd into the most popular stocks, not from buying what everyone else is buying, but from having the conviction to invest in situations that look ugly on the surface, but have the potential to be beautiful underneath. The company that could 5 times your money in 3 years is out there right now. It is probably a business you have heard of but dismissed. It is probably trading at a multiple that seems to reflect permanent decline. It is probably being run by management that has lost the plot. And it is probably one CEO change, one strategic shift, one spin-off away from a complete transformation. That is the activist opportunity. That is how patient, analytical, value-focused investors generate extraordinary returns. Not through luck, not through timing the market, but through understanding businesses better than the market does, and having the patience to wait for value to be recognized. The next 5 times return is out there waiting to be found. The question is whether you are willing to do the work to find it. Now, let me go deeper on something that separates successful activist investments from failures. It is the quality of the underlying franchise. I have learned this lesson painfully over the years. You cannot activate your way to success in a bad business. You need a good business that has temporarily lost its way. Think about it this way. A bad management team running a great business will eventually be replaced. The business will survive and ultimately thrive under new leadership. But even the best management team running a fundamentally broken business is fighting gravity. They might slow the decline. They might extract some value along the way, but they cannot change the fundamental economics of a dying industry. This is why I spend so much time analyzing the core business before I even think about the activist angle. Is this a company with a sustainable competitive advantage? Does it have pricing power? Are there barriers to entry that protect it from competition? Is the industry growing or shrinking? These fundamental questions matter far more than any governance issue or management mistake. Let me give you a concrete framework for evaluating franchise quality. I call it the 5 pillars of a great business. Any company that meets all 5 of these criteria is worth serious consideration as an activist target, if it is trading at a discount to its intrinsic value. The first pillar is recurring revenue. Companies that get paid month after month, year after year, without having to resell their customers are inherently more valuable. Think about subscription businesses, software companies, insurance companies, real estate companies with long-term leases. The predictability of cash flows makes these businesses much easier to value and much more resilient in downturns. The second pillar is high switching costs. When customers face significant friction in moving to a competitor, the business has durable pricing power. Enterprise software is a great example. Once a company is using your platform, once all their data is in your system, once all their employees are trained on your tools, they are extremely unlikely to switch. This stickiness creates sustained competitive advantage. The third pillar is network effects. Some businesses become more valuable as more people use them. Social networks, payment platforms, marketplaces. These businesses have built-in competitive moats that get wider over time. The leader tends to stay the leader because the network itself is valuable. The fourth pillar is low capital intensity. Businesses that generate lots of cash without requiring significant reinvestment are inherently more valuable. Asset-light models, service businesses, software companies. These businesses can return enormous amounts of cash to shareholders or use it for acquisitions. Capital-intensive businesses like airlines, steel, or heavy manufacturing require constant reinvestment just to maintain their competitive position. The fifth pillar is pricing power. Can the company raise prices without losing customers? This is the ultimate test of competitive advantage. If customers will pay more for your product than competitors, you have something special. If you are constantly competing on price, you are in a commoditized business that is very difficult to fix through activism. When I find a company that has most or all of these characteristics, but is trading at a significant discount to fair value, my ears perk up. That combination, great business plus low valuation, is the sweet spot for activist investing. Because those businesses do not stay cheap forever. Eventually, the market recognizes their quality. And if you can help accelerate that recognition through constructive activism, the returns can be extraordinary. Now, let me talk about the mistakes I have made so you can learn from them. Because I have definitely not been right on every activist investment. My biggest lesson came from Valiant Pharmaceuticals. I invested several $billion in what I thought was a unique pharmaceutical platform. The company was acquiring other drug companies, cutting costs aggressively, and raising prices on drugs with captive customer bases. On paper, it looked like a money machine. What I missed was the sustainability of the model. The price increases were attracting regulatory and political attention. The acquisition pipeline was drying up. The accounting was more aggressive than I realized. And when the music stopped, the stock collapsed. I lost close to $4 billion. The lesson I took from that experience was humility. No matter how smart you think you are, no matter how much research you do, you can still be wrong. The market can be right when you think it is wrong, and when you are dealing with businesses that depend on regulatory or political tolerance, that tolerance can disappear overnight. Since Valiant, I have been much more careful about industries that are politically sensitive: healthcare, pharmaceuticals, financial services. Any business that depends on government allowing certain behaviors is inherently riskier than it appears, because governments can change their minds, and when they do, shareholders pay the price. Another lesson came from my long battle with Herbalife. I was convinced that Herbalife was a pyramid scheme that would eventually collapse or be shut down by regulators. I made $1 billion short bet against the stock. Carl Icahn took the other side and went long. 5 years later, I had to admit defeat. Herbalife did not collapse. The FTC investigated but did not shut them down. The stock went up, not down. I lost several $100 million on that position. What did I learn? Crusades are expensive. When your thesis depends on regulators taking action, you are not really analyzing a business anymore. You are making a political bet. And political bets are very difficult to win. The regulators may agree with you but still not act. The company may make changes that are just enough to survive. The stock can stay irrational much longer than your investors can stay patient. These days, I focus almost exclusively on long positions. I look for companies that are undervalued, not overvalued. I look for situations where I can help create value, not just profit from destruction. I have found that constructive activism, working with companies to make them better, is more reliable and more profitable than destructive activism that depends on things going wrong. Let me now give you a practical checklist for evaluating activist opportunities. These are the questions I ask myself before making any significant activist investment. First, what is the company worth in a realistic upside scenario? Not the blue sky scenario where everything goes perfectly. The realistic scenario where the company addresses its problems and executes reasonably well. If the upside is not at least double the current price, I am not interested. The potential reward has to be large enough to justify the risk and the time commitment. Second, what is the downside if I am wrong? What is the floor on this stock? Is there asset value that protects me? Is there cash flow that prevents a total wipeout? I need to understand my downside before I focus on the upside. Third, what specifically needs to change? Can I articulate a clear plan for value creation? If I cannot explain in simple terms what the company should do differently, I probably do not understand the situation well enough to invest. Fourth, is management capable of executing the changes, or do they need to be replaced? This is critical. If management can execute, the path to value creation is much faster and smoother. If management needs to be replaced, you are signing up for a longer and more contentious process. Fifth, what is the timeline for value creation? Activist investments typically take 2 to 4 years to fully play out. Can I realistically commit capital for that long? Are my investors patient enough? Is the opportunity large enough to justify tying up capital for years? Sixth, who else might be interested in this company? Are there strategic buyers who might want to acquire it? Are there private equity firms that might take it private? Are there other activists who might get involved? Having potential buyers in the background provides a margin of safety. Seventh, what are the risks that could prevent the thesis from playing out? Regulatory risks, competitive risks, technology, disruption, management, entrenchment. I try to identify every reason why I might be wrong and assess the probability of each. Only when I am satisfied with all of these answers do I move forward with an activist position, and even then, I size it appropriately to account for the inherent uncertainty. Let me leave you with some final thoughts on the current opportunity set. After years of momentum investing dominating the market, there is a growing universe of undervalued companies that could benefit from activist involvement. The combination of higher interest rates, tighter credit, and increased scrutiny on corporate governance is creating fertile ground for value creation. Industries that have been out of favor for years are starting to look interesting. Consumer companies that lost market share during the pandemic disruption, industrial companies that have been ignored in favor of technology stocks, financial services firms that trade at significant discounts to book value. These are the hunting grounds where activists are finding opportunities. The key is patience. The key is discipline. The key is being willing to do the work that other investors are not willing to do. Reading every filing, understanding every line item, knowing the business better than management does, that is where the edge comes from. Not from trading skills, not from market timing, from simply understanding businesses more deeply than anyone else. I have been doing this for over 20 years. I have made billions of dollars for my investors. And I can tell you with complete conviction that the opportunity in activist investing has never been better. There are companies out there right now that are trading at 50 cents on the dollar. Companies with great businesses, fixable problems, and clear paths to value creation. Companies that could 5 times your money in the next 3 years. The question is not whether these opportunities exist. They do. The question is whether you have the discipline to find them, the patience to wait for the thesis to play out, and the courage to act when you have conviction. Those are the qualities that separate the investors who generate extraordinary returns from everyone else. This is the opportunity. This is the moment. Go find the next great activist investment. Do the work, build the position, and let time and compounding do the rest. The returns are out there for those willing to pursue them.